Welcome back to our final episode summarizing the Little Book of Common Sense Investing by John Bogle, the father of index investing. In part 1, we learned why most investors underperform the market. In part 2, we exposed the hidden fees that quietly destroy long-term wealth. And now in part 3, we're diving into the solution. Bogle's proven, simple strategy for building long-term wealth through low-cost, diversified index investing. If you're ready to stop gambling and start growing, this episode is for you. 1. The winning formula. Voiceover. So what's the secret? According to Bogle, the winning formula for wealth is remarkably simple. Own the entire U.S. stock market and do nothing. Just hold it. That's it. Why? Because over time, the stock market as a whole grows as companies innovate, expand, and generate profits. If you own the entire market, you're guaranteed to earn the average market return. And historically, that's been 7 to 10% annually over the long term. The key is, keep costs ultra low. Don't try to time the market. Stay diversified, hold for the long term. 2. Why index funds work. Index funds are designed to match the performance of a broad market index, like the S&P 500. They don't try to beat the market. They are the market. And that's actually a huge advantage because the math is simple. Gross return minus costs equals net return. Most mutual funds charge high fees, trade often, and underperform the market after expenses. But index funds like Vanguard's Total Stock Market Index, VTSAX, charge less than 0.05% annually, and they consistently outperform over 80% of actively managed funds. It's like this. Active fund, schöner, expensive, inconsistent. Risky index fund, schöner, cheap, steady, diversified. 3. How to build a Bogle-style portfolio. So how do you actually build a Bogle-style portfolio? Here's the simplest version, what many call the 3-fund portfolio. U.S. Total Stock Market Fund, IRNG, VTSAX or VTI. International Total Stock Market Fund, e.g. VXUS or VTIAX. U.S. Bond Market Fund, e.g. VBTLX or BND. Allocate based on your risk tolerance and age. Younger investors, 80 to 90% stocks, 10 to 20% bonds closer to retirement, 60 to 70% stocks / 30 to 40% bonds. You can automate contributions monthly, rebalance once or twice a year, and otherwise, leave it alone. That's the common sense Bogle preached. 4. Why simplicity wins Wall Street wants you to believe investing is complicated, but Bogle proved the opposite. The greatest enemy of a good plan is the dream of a perfect plan. Stick with the good plan. Simplicity isn't just easier, it actually outperforms. Why? Because it removes emotion, fees, and short-term noise. The data is clear. Index investors earn more, they stress less, they rarely panic during crashes, and they reach their financial goals faster. 5. Final thoughts and action plan. So here's your Bogle-style action plan. Step 1. Choose low-cost index funds. Step 2. Automate monthly contributions. Step 3. Stick to your plan through ups and downs. Step 4. Ignore hype, noise, and financial media. Step 5. Rebalance yearly and let compounding do its work. This is how you build real wealth. Not fast, not flashy, but guaranteed to work if you give it time. If you enjoyed this 3-part series, don't forget to like this video, subscribe to the channel, comment below, I'm investing the Bogle way. Thanks for watching. And remember, investing should be boring. If it's exciting, you're probably doing it wrong. See you in the next video.